What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a solid-bodied green bar with just a little bit of a lower wick here, indicating some selling pressure after the open. But look at where we've closed the weekly bar, right at the top of the weekly range, which strikes me as incredibly bullish. We also know that some of the candle body is comprised of the CPI gap up, and we will discuss that on the daily time frame in just a moment. But structurally speaking, the buyers are in firm control here on the weekly time frame. From a location standpoint, we certainly have a bar-to-bar higher low and a bar-to-bar higher high. That is obviously bullish, but the most important takeaway here on the weekly time frame is what happened to the trend, right? If we think about all-time high, lower high, look at what just happened. We finally formed a new higher high on the weekly time frame. So is the trend starting to shift? Absolutely, the answer is yes. Now, to confirm the weekly trend change, we would need a higher low pullback and then continuation, right? That's the next step in confirming a new uptrend. So where would an ideal higher low pullback form if one were to happen in the first place? In last week's video, we discussed the possibility of an inverted head and shoulders with a neckline right at these prior highs. Now, I would still argue that that neckline is just as important, but instead of being an inverted head and shoulders, we would just look at it like a break and retest on the weekly time frame. So a break, retest, and then go would be like a picture-perfect scenario for the SPY to confirm the weekly trend change and continue to the upside. This is rainbows and butterflies, picture-perfect, belongs in a textbook. The other reason why this area is so important, of course, is because as we've been tracking, we want this, the high volume nodes on the weekly time frame, that is the second most high volume node on the weekly chart. The point of control and the highest volume node is overhead closer to 440. And remembering that markets like to be drawn to high volume node, it would seem reasonable that we will either get continuation into this area here, or a pullback can happen, and we want to see that high volume node hold up as support. Again, this is the picture-perfect ideal scenario, and it makes sense based on what we're seeing from a structural perspective. But very rarely does the market give us that picture-perfect scenario that we want to unfold. So let's just envision something that's not picture-perfect, right? If we pull back deeper than this prior set of highs, is it the end of the world from a trend reversal perspective? Can we still form a higher low is the question you need to answer. And the answer should be yes, right? There's still a high probability that we form a higher low as long as we're above roughly 390 on the weekly time frame chart. We're all good, right? That can produce a higher low. For this trend to reshift back to the bear's favor, we would need then a lower high from here to here, which would obviously require many more, well, not many more, but more than 1 week's worth of trading data. So that's not really on the table for this upcoming week's worth of trade. The other thing that would put the weekly chart back in the bear's court would be a straight move lower for a new lower low underneath this set of lows in here. Does that strike you as a high probability outcome for the next 5 trading days? I would certainly argue no, not really, not whatsoever. This would be like a 1% chance type move that it would look something like that, okay? So in my estimation, really important that we spent some time here on the weekly chart because things are starting to change to the bullish side, right? The trend is reversing back to the upside on the weekly chart. Let's drill down to the daily now and talk about pertinent trading levels into the upcoming week's worth of trade. Let's pop on our moving averages, 50 SMA in blue, 200 SMA is in green. I think it would be better if I adjust the chart manually so we can have this front and center. There we go. So first things first, weekly expected move. If we stay contained within the week's expected move, notice it will keep the uptrend intact. If we move all the way to the bottom and support here, it's a clear higher low from this prior congestion lows to here, right? Higher low. Daily trend remains to the upside. If we make the move to the top, obviously that's just bullish continuation with a new higher high. So the expected move keeps the bull trend going. the last week's expected move was breached to the upside, and I got multiple questions on whether or not I was concerned about this being extended to the upside. My answer is no. And we discussed this very briefly in the pre-market live streams, right? But markets like to move from balance to excess. We had this period of balance right here, and we finally saw some excess. So is it the end of the world to move through the top of the weekly expected move? No, the expected move was calculated based on volatility contracting, and we finally saw a little bit of expansion. So to me, again, this is not overextended to the upside. It was just seeing expansion of range, right? That's the natural way that the market moves. It contracts, it expands, it balances, it finds excess, right? So that does not strike me as being overbought here. Now, would I advocate for new longs up here as we're approaching resistance and the resistance trend line? No, not necessarily. I do still think that the bulls are in firm control. We'll talk about why in just a moment, but let me give you a little perspective on that trend line and the levels that are in play. So this level is, or the trend line rather, is the trend line from the all-time high and has not been tested yet. That is a very, very important trend line. And the fact that it's coinciding with the 200 SMA, to me, would seem like an area of super resistance, right? Two things coinciding for confluence, very likely that you can see some sort of pullback happen off of that. And as we've discussed, pullbacks are A-okay at this point in time, so that does not strike me as concerning. In terms of what this means for positions, though, again, we are starting to get into overhead resistance. The risk reward is not as favorable for upside. Doesn't mean go short the market, but you're just dealing with very limited overhead range to trade for upside. I'm not saying don't scalp this on 5-minute patterns, but swing traders, people who have trade durations that are longer than, a couple of hours, I would start to be a little bit cautious as we head towards this resistance. Now, let me explain why I still feel as though the bulls are in full control, even with the CPI gap up and not feeling like we're extended, right? So number one, CPI gap up gives us a partial fill. The sellers, quote unquote, should have done their job and filled the gap, right? There's very little structure in here. The inventory is imbalanced. We were watching for a gap fill. It didn't happen. Sellers strike me as weak. That's instance number one. The next gap higher is PPI. That's on Thursday. We open here. We close the gap. We correct some of the overly net long inventory. And this immediately reverses on Friday. We make a new higher high on Friday and close at the highs of the weekly range that we just saw. To me, these are not new money sellers positioning for a massive short in the market. That is net long inventory with terrible trade location, not getting paid immediately on the Thursday open. Okay, so sellers do not strike me as being strong in this marketplace still as we climb this quote unquote wall of worry to the upside. Again, I don't think that the risk reward is favorable into this trend line for new long duration longs, but overall, I'm not seeing any excuse or any reason that the sellers are just all of a sudden going to hit it hard here. There's no evidence of stronger selling taking place based on what I can see. So that's what I've got from a sort of psychology perspective in terms of reading the candles. And again, just be mindful that as people potentially get more and more and more long towards the top with poor location, it increases the odds of the possibility of liquidation break. And by that, we mean, longs, closing positions, leading to some selling pressure. It's not new money sellers hitting the market, but just longs closing out, which can, present itself as really fast-paced, ugly selling, right? But just don't get fooled into thinking it's new money selling until we have a change in daily trend. So that's what I've got for you on the daily time frame chart. Couple of other things here outside of levels and candlestick analysis. Obviously, let me just give you the numbers, right? So 428.65 is that horizontal overhead resistance, trend line, and then 200 SMA after that are really what we have to contend with. Ideal consolidation happens above 420, and deeper pullbacks that we saw on the weekly time frame want to respect that break and retest level at 415.35. Those are the numbers early on in the week. In terms of Fibonacci analysis, because we've been doing this recently as well, let's come in from the all-time high and just show you once again that we are still firmly accepting above the 38.2 fib. That's your 38.2. All of the price action over the past 2 weeks has been above, and we're actually through the 50% at this point in time. The resistance trendline and the 200 SMA is starting to coincide with the 61.8, just furthering the idea that upside reward is getting more limited without some sort of tighter risk pullback or consolidation first. The time to get long was like on the CPI gap up as we realized that the gap was not going to fill, right? That would have been fine for trade location, but new longs up here, obviously not as favorable. So that's Fibonacci perspective number one. Fibonacci perspective number 2/3, 4, 5 is going to be coming in from the lows, right? Firmly above the 38.2, higher low pullbacks are technically acceptable on the weekly time frame all the way into these lows around 402.80. And if we come in from here, or actually this one, sorry, we really want to take it from, so these were two equal lows, right? This is where we would say the rally started from. Notice that your 38.2 is very close to that 408.25. So just this general area, the higher low pullback, if it comes, wants to be in this general area, not underneath it. If it's underneath it, it would not be as ideal from a trend continuation perspective because, of course, we would be giving up this set of lows in here. So that's what I've got from the fib perspective. The last thing I've got for you on the SPY daily time frame chart is many people have also been concerned with the volume, which is tapering off to the downside. All I would say about that is take a look at a 5-year chart. Whenever the market is seeing volatility and downside, you always get a spike in volume. Here's your downside, right? Here's an increase in volume. Here's your downside. Here's an increase in volume. As the market starts to recover and make new trends to the upside, volume always is on a sort of much more muted level. So I'm not overly concerned with the fact that volume is tapering off. It's the natural way that markets move, right? It's very easy for everybody to hit the button and panic sell during nasty periods of volatility. It's much more difficult to have the confidence in saying, okay, I'm going to start allocating more and more capital to longs, with big volume, right? So it always works that way in the market. And just to answer the question on volume, I'm not overly concerned with the taper that we're seeing here. Strikes me as natural market activity. Let's get into our sectors now. Of course, this is where we know we can really keep tabs on what's going on in the underpinnings of the market. Let's drop this to a yearly again. That is good. So what's going on in the XLY? So here's our contraction of range starting to close above on the Friday session right at resistance. It strikes me as bullish, but it's obviously not as bullish on a relative basis as the SPY itself. If this continues, it keeps the SPY, again, just moving higher, right? There's no reason why if the XLY is aggressively up into that next level, the SPY would it not at least be sideways unless all of the other important sectors are crashing, and the XLY and XLK usually work in conjunction, right? They're usually not too far off, and they're also really heavy weighted components of the SPY. So on the XLY, things look good. Strikes me as bullish pressure if we can continue this breakout of this area of consolidation and balance from in here. The concerning look on the XLY would be if we get some sort of look above and fail and then fill the gap to the downside. That would provide bearish pressure, obviously, for the upcoming week, but it wouldn't really affect the trend here on the XLY. Remember, on the weekly time frame, we have a double bottom here. It would be a weekly break retest. Can we put in the higher low would be the question. Remember, the daily trend looks something like this. So a higher low pullback to here would not be the end of the world. Of course, on the day-to-day, it would mean bearish pressure for the S&Ps for the upcoming week or whatever. But in the grand scheme of things, structure is fine, right? So that's important there on the XLY. XLK, same idea, right? Except obviously we're a little bit more firmly outside of the balance area. Bullish pressure for the S&P 500. All of the same implications from psychology in terms of the CPI gap not filling, the PPI gap fill reversal. It's all there, right? So to me, this chart looks and continues to present bullish opportunities. I think your upside reward is starting to get limited as we come into this major resistance here and also the 200 SMA. So this also would sort of tell me, hey, maybe take it a little easy on aggressive longs in the S&P 500. But overall, if a pullback is produced on this one, you want to see a higher low gap fill reversal off of that CPI gap up. That number is 144.80 roughly. So bullish in the XLK. We can afford a higher low pullback. But ultimately, upside reward early on in the week, at least, is going to be slightly limited. Next up, we've got the XLB, materials, lightweight sector, just taken off to the upside, well outside of the neckline of its head and shoulders. We already had the break retest and go. We're moving through this thin structure. Great bullish pressure for the marketplace, but overall, really lightweight sector. It's not going to save the day. And if a pullback unfolds all the way to the neckline again, it's also not going to ruin the day either in the S&P 500. Moving on. XLC, communications, much more important, heavier weight sector. This is finally starting to quote unquote catch up to where the SPY is. Remember, on a relative basis, the SPY is trading somewhere up here, and the XLC is still stuck kind of underneath this balance area in here. So if this continues to pull its weight and move higher to quote-unquote catch up, that strikes me as something that will help keep the S&P 500 neutral, if not add to the bullish pressure that we can see over the course of the upcoming week. On this one, it's got to stay above 58.18, 58 even going forward because it was the prior double top and where we saw a hang up, right? We want to see something like this for pullbacks or just sideways and then higher to catch up. So overall, overall, XLC does strike me as playing nicely and being bullish. The real estate sector, we know it's technically D for defensive. It's a really lightweight sector as well. Just like materials, we sort of have this really sloppy. You could draw it like this, inverted head and shoulders. You could draw it like this, inverted head and shoulders. Either way, above the neckline, bullish pressure for the marketplace. But just like the XLB, it's not going to make or break the day. So we're moving on. Next up, utilities. This does strike me as a medium-sized red flag now. Last week we were saying, okay, it was kind of a small red flag. Now it's turning into a little bit bigger of a red flag. Why is the utility sector making a run for the all-time high first, right? This is D for defensive, no doubt about it, inside of utilities. This should not be leading the charge, making the first all-time high, right? This strikes me as more of a medium-term red flag. The only thing that's, keeping me okay about this market is the fact that the XLK is moving higher, the XLY is moving higher, as we'll see in financials. Really impressive there as well. So the heavyweight sectors are rotating higher. It's a head scratcher. Why is the utility sector going to be the first one to make a new all-time high? That does not quite add up. So I'm just keeping an eye on it. Next up, we do have the financial sector, which again is a heavyweighted sector, an important sector. And look at how it's screaming to the upside. So again, compare this to the XLU, and all of a sudden that red flag is, it's still there, but it's not as important as if, let's say that the financials was doing something like this and the SPY is still rallying to the upside. That's a much more concerning situation. But to see this aggressively higher here strikes me as a really good look for the S&P 500. Obviously, we've got the equal high to here now, so the weekly trend is starting to neutralize in financials as well. This is definitely climbing the wall of worry. I would not advocate for new money longs here. This does strike me as extended. The consolidation was here. Reasonable pullback or consolidation can happen. That sets up the next risk-friendly long to the upside. So don't be surprised if financials kind of cool off over the course of this upcoming week, and maybe that's just a neutral implication for the S&P 500. Overall, in the grand scheme of things, yes, this could do this and produce a higher low on like the weekly time frame. It would obviously just be bearish pressure if that pullback unfolds throughout the duration of the upcoming week. I would prefer to see some sideways balance and consolidation above 34.61. Continuing along, we've got the XLI Industrial 7%, as we infamously say, of the S&P 500, breaking out of its bull flag here, making the move higher. Bullish pressure for the marketplace. Is it going to be a save or break the day type sector? Not really. If it does continue higher and get more acceptance over the 200 SMA, just looking for continuation. The chart pattern would suggest, just like the XLF, we've seen the consolidation here. Now we've seen the expansion. We might be in store for another period of digestion of this overall move, which again is just more of a neutral implication for the market. So overall, as we've moved through some of these sectors, you can certainly see how we're building the case for neutral to, if not, continued bullish pressure in our marketplace. XLV, this one strikes me as bullish as well, right? Our consolidation is happening well above this. Think about it like building blocks or stair steps, right? We clearly have higher lows remaining in place. And look at the Friday close right at the top of this sort of range in here. We're outside of the mini range. Remember, we were discussing this, but we're still inside of this large container bar here. So early on in the upcoming week, looking for the XLV to break out here just based on the Friday close. This has seen compression with no expansion yet. So if this moves higher, obviously being the second heaviest weighted component of the S&P 500, it will be big bullish pressure for your marketplace. Next up, we've got the XLP, consumer staples. What's going on in this one? This is D for defensive. We do want to see it lag, so the more time it can spend in this consolidation range, the better. We would want to see the XLV break out first, and then maybe this can follow suit later on in the week. Of course, still bullish pressure for the marketplace. Wants to stay above 74.56. I don't think we gave you support in the XLV, so let's do it now. In an ideal world, we stay above this now, right? So that level is going to be 132.60. As long as we're above that, that's like ideal picture perfect consolidation and breakout. If we just remain in the overall range, 130.50 is your number. Anyways, last but not least, we've got the energy sector, just like utilities, starting to become a little bit of a head scratcher. It was playing nicely in here, but Thursday and Friday certainly changed that with equal highs up towards this area. So overall, not the best looking chart, but again, because the financials are so strong, because tech is so strong, and the XLY discretionary is so strong, I'm willing to give these a medium red flag instead of big red flag. Hey, divergence, this is not good, right? These things are okay as long as we see the heavy-weighted components continue to really pull their weight. Let's take a quick peek at the sector chart. If you're not familiar with this is the ratio grid. You can set it up by watching the tutorial in the top right-hand corner. The top four are our risk-on sectors, and I would certainly start to argue that we've got 3 out of 4 playing nicely. XLK obviously looks great, hanging out at the highs. XLY hanging out at the highs as well. That is bullish, risk-on, and Also, look at the XLF, finally recapturing that descending 50 SMA. That's the gold line. This strikes me as bullish and more of a risk-on interpretation, especially when we pair it with that daily chart we just saw. So 3 of 4 is good enough to turn risk on. And the XLV, if it breaks out of its consolidation range that we saw on the daily, I imagine this perks back up and at least goes back to neutral. Right now, it's not looking great, but that daily chart, if it breaks out, will impact this to the upside and possibly save the day. So 3 of 4 is good enough to turn risk on, and if the XLV, wants to play nicely, that's just an added bonus, especially considering it's the second heaviest weighted component. Bottom 4, these are the risk off sectors. Notice how they're all turning off. The XLP is pointing lower. That's a good sign. The XLE energy, although the daily chart is kind of a head scratcher, it's just going sideways down here. Strikes me as fine. That's risk off is off. Same thing here. We'll put a check. The real estate sector, really just sideways, tangled up around that 50 SMA. It's fine. Risk off. And the utilities, although it's about to make that new all-time high on a relative strength basis, it's really just going sideways. This, of course, measures the relationship between how much the XLE is up versus the SPY is up. And in the grand scheme of things on the ratio grid, it still is kind of at minimum neutral here. So even if you wanted to put a tilde for neutral, still 3 of the 4 in the risk off is turning risk off. So the market is poised to continue higher, for that weekly trend to really reverse and confirm higher, even if we get a higher low pullback, right? And the sector ratios are certainly starting to confirm that. Let's take a quick peek at the TNX now. This one, we're going to keep it really simple here. We discussed in detail the CPI and the implications of the Fed on the Wednesday video. If you're interested, you could go back and watch that. But going forward, now that the economic data has come out, bonds obviously got it right. Inflation kind of looks like it has peaked in the short term, and rates are stabilizing. Just keep in mind that this is bullish pressure for the XLK, having a stable rate environment. Obviously, if this trends lower, that's even better for the XLK. And the XLF obviously is fine with these higher rates, right? And knowing that we're kind of in a position where people are still incentivized to borrow, and it's not like rates are so out of control that no one wants to go to the bank and borrow money. So TNX looks great going sideways in this overall range. We're going to take a look at the VIX now. This one, all I would say about this is just fantastic move. Multiple days of acceptance underneath 2050. To me, that is the look that we were essentially looking for. This is indicative of the market being content with sort of reversing to the upside, right? The big fears in the market have evaporated, so to speak, of those big, nasty, unforeseen rate hikes, especially with the CPI data coming out and the PPI data coming out on Thursday as well to sort of confirm that, yeah, inflation actually did tick lower. Don't get me wrong, inflation's still out there. I'm not saying it's just completely disappeared, but it's no longer looking like, at least on the month to month, that it's spiraling out of control. So anyways, VIX indicates healthy environment for the market to move higher. We'll take a quick look at the VVIX, which is still indicating, pretty important levels underneath 103. No one's buying SPY puts, no one's buying VIX calls, and that to me would just continue to sort of support the thesis that the market may be still in the grips of a gamma squeeze to the upside. If we quickly take a look at, let's take a look at the SPX. And we'll look at the sizzle index here if this wants to load. Thank you. So the call sizzle index on Friday is up around 4.9. Granted, the put sizzle index is around 4.9 as well. But if you pair that with what's also going on in the VIX, because there are options on the VIX, not the VVIX, you can see that people are actually buying puts on the VIX, right? They're not buying VIX calls, which is indicative of no one hedging. So is the market still experiencing some bit of a gamma squeeze? It would certainly seem that way based on the options information that we have available to us. Let's take a quick peek at our market internals. Let's go ahead and navigate to this screen. If you don't know what this is, again, video tutorial top right-hand corner, you can check that out. What do we see on the volume? All of the up days that were significant, so CPI, and then the follow-through day on Friday, I should say both, not all. Both of them reading significant reads above 300 million. Again, on the pullback day Thursday, look at where volume is. It didn't even come close to 300 million. Therefore, again, I'm convinced that those were not new money sellers, just longs with poor location closing out. In terms of the advanced decline line, you will realize the same exact thing, over-correlated on the CPI move higher. On the pullback day, we're still in positive territory. It's not like the advanced decline line was negative. And on Friday as well, working our way towards that nice solid trend zone up here. So no big concerns from that perspective. Obviously, the ticks as well confirming. CPI day positive, Friday follow through positive as well. And the pullback day still positive, believe it or not, even though we sold off for a majority of the day there to close the gap. So internals support the idea that new money sellers are not here. And we are sort of confirming these breakouts as being strong and not really essentially just fake outs on light volume on CPI and the Friday follow-through day. Overall, liking everything we're seeing so far about this move to the upside. Next up is the market profile. If you don't know about this one, again, quick video tutorial for you in the top right-hand corner. All I would point out is look at the point of control from Friday. I mean, it went right to the high of day with all of those market on close orders. Strikes me as incredibly bullish. We don't really have single prints to contend with, but there is fairly thin, we want this, thin structure through here. There's some decent pockets of volume at different prices. It's not like we have, a complete string of like nothing going on. You can see in this pre-market session there's virtually no volume, right? It's not like we have that type of instance, but just know that this is fairly thin. So if a pullback does come, there's not a whole ton of support there on the intraday from the Friday session. But overall, I mean, look at this. We've already tagged up this point of control. We've tagged up this point of control from the CPI gap up. Granted, there are some virgin points of control stacked underneath us, but for now, everything looks good in terms of structure up here from the market profile perspective. And again, the main takeaway is that the point of control did migrate higher right to the high of day on the Friday session as we rallied. Let's get back on over to the platform and round out our broad market. What's going on in the Qs? Certainly, the psychology is very similar to the SPY. Let me quickly rewind by telling you that the secondary trend line here has broken into the end of the week. That strikes me as bullish information number one. Of course, CPI, same psychology. That gap was a partial fill. The next day, PPI, we fill the gap, and Friday, we rally back up towards the highs. This did not produce as significant of a higher high. Of course, the XLF is really what pushed the SPY higher there. We could see that, right? And there's obviously no financials in the Qs, or very little of them anyways. So to me, this has the possibility of, more overlap here is consolidation, and we can look for continuation outside of this compression, right? Here's the compression. Now we're starting to see that expansion, whereas we've already seen the expansion in the SPY itself. And that aligns with what we had to say about the XLY as well as the XLK. Notice that the weekly expected move keeps us in an uptrend, just like the SPY, and the next level overhead on the break of 329.65, call it 330, is the bottom end of this prior balance from in here around 337.50. That's very close to the top edge of the weekly expected move as well. On pullbacks that breach the low edge of the weekly expected move, look for your CPI gap to fill and then a reversal out of that. In the grand scheme of things, that still keeps the daily trend alive, with that being a higher low, very nuanced, but a higher low, much higher than this one right in here. So QQQ, all good for upside and looking for continuation as well, even noting that we have more balance here, and we can see that without looking for a pullback or digestion first, right? We have two overlapping days instead of a stronger close above on Friday. Last but not least, in the broad market, we've got IWM, Russell 2000, and the small caps. Just incredible moves here, guys. The small caps have been signaling risk on for quite some time. We've been discussing that for the past couple of weeks, really. This is already above that target that we literally just discussed in the Qs. On a relative basis, that was the overhead target we just discussed in the Qs, and the IWM's already over that, right? So to me, relative strength is still in the small caps. This is indicative of risk on environment. Small caps are rallying first, or not first, but they're catching up rather, which, people make. Small caps are generally riskier, right? So that's why it's a risk on sort of indication. So seeing these, levels in IWM strikes me as bullish confirmation of what's going on in the overall marketplace. Higher low is produced if the weekly expected move holds. Obviously, it's above that level we just discussed. Even if we pulled back a little bit deeper than that, the weekly time frame would still be a higher low above this prior high, right? Basically, what we discussed on the SPY was a break, retest, and go. There it is in your IWM. So all good, even if we rotate into 190.71, which would also roughly be filling the CPI gap up. So overall, broad market, bulls in control, but be cautious of limited upside, especially in the SPY itself. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we will jump directly into Apple. What's going on here? Watching for the 100% retracement of this move in Apple when and if, in the first place, we get to 179. That's where I would look for a more significant pullback or digestion consolidation to happen inside of Apple. It's very rare that on 100% retracements, you just immediately continue and get more of a move in that direction. Usually, it turns into higher low pullback or consolidation, and then we can get a break. So 179 strikes me as being very important here if we just see upward continuation. The reason we're talking about upside is, of course, all of the same psychological reasons we discussed in the broad market. CPI gap didn't fill, PPI fills, and then on Friday we get a new higher high close. strikes me as no strong sellers here inside of Apple. If a pullback does develop early on in the week, of course, I'm probably looking at the CPI gap to fill. That's the trade there to the downside. I wouldn't want to get chopped around in this general area. So it's underneath 167, fills down towards 165.25. You could even move and start to look at the support trend line as well. Speaking of support trend lines, obviously, if that pullback does unfold, it does not violate any major daily structure, right? That would certainly produce a higher low pullback off the trend line. And if we get a bounce off of it, just looking for more upside, right? So Apple has to fall into the bullish category. Netflix, really, really important that you watch this one this upcoming week because we're moving into the sort of, void, essentially, right? There's nothing there from the prior earnings cycle. So to me, very, very important to watch for the break of roughly 250 to rotate up towards 330, about $80 worth of gap here inside of Netflix. That is sizable and with very little resistance in there. I'm not saying it's going to fill in 1 or 2 days, but it should fill sooner rather than later because of the lack of structure, right? There's no resistance in there to provide any hangups. So that being said, let's zoom in on like more recent price action in here and see what's going on. Inverted hammer on Thursday with a slight look above into that area, but notice that the pullback did not happen underneath that inverted hammer low. So again, sellers not really showing their hand here in Netflix to me, watching for that upside continuation. If a pullback does happen, it's ultimately not the end of the world on the weekly chart for a break, retest, and then reattempt something there. So your critical support in Netflix is going to be at 228.13. As long as we're above that, I would maintain a bullish stance. I would not get bearish in Netflix unless you're trading for the CPI gap close or if there's just big price action that comes all the way underneath 228 and then we're moving lower. That obviously would be a failed breakout and we can shift tone then. But for now, falling into the bull category, especially with that 80-point gap overhead. Tesla's up next. Really interesting chart. Everybody and their sister is talking about this one and how there's the possibility of a short squeeze. Look at all of these red bars, all of the selling pressure that was there, and it didn't go anywhere. Tesla did not go anywhere to the downside. Granted, we're slightly off of these highs. That's true. But to see 1, 2, 3, 4, 5 days of really large range red bars really not make any progress, right? You basically had gaps that then produced moves lower, move lower, gap higher, lower, right? So shorts, if they're loaded up in here and we start to take out this level, 907, it's game on roughly until 1,000. Right, I think there's probably enough fuel in the tank from a short squeeze perspective to take out the top there, 907, take out these highs, and then see what happens at 1,000. So Tesla watching for upside here just based on that psychology of these shorts just not getting paid at all. If they start closing out, that's where we're looking for that move. To get bearish in Tesla, really this is just a choppy range. So I wouldn't really trade this for large moves. I'm not saying don't scalp in there, that's fine. But for large moves, again, break of 907 gets us bullish. And if we take out the bottom of the range, then fine. These sellers are content and maybe we move a bit lower. Our target underneath 841 would be 808 and then this gap underneath N50 SMA. So one step at a time, but I do think that the sellers are getting a bit impatient here, especially with that Friday reversal back up towards the top of the range there. So Tesla watching for the squeeze to the upside. Google is up next. What's going on here? Really, really nice break and retest of the top, of the balance range. Thought I was going to do the whole video without a little cough/clearing of the throat, but unfortunately still lingering. Anyways, break retest on the top of the range and moving higher on Friday. Anything that remains above 118.75 now strikes me as optimally bullish. Next breakout is over those highs there at 122.50 and the target overhead is 126.50. That's your upside. If we move back lower underneath this is not ideal, but the structure is still okay if we close the gap and reverse fairly quickly back above 118. I would say any price action that closes the gap and does not reverse, so just hangs out down here, that starts to become concerning for a look above and fail on this range. Over time, the target is, yes, the bottom end, but one step at a time, right? You would want to watch the break of 116.35 to get us to the 50 SMA over the course of this week, right? That would be how you trade that to the downside. Meta up next. What's going on here? Consolidation, XLC, right? We've been watching that move higher. Meta kind of needs to take out this double top, which now has another touch on it at 183.78. If we can do that, that puts the bulls in motion, and we're looking for a rotation ultimately to the top of this. First, obviously, is 188.50, but 196.65 starts to get Meta more on a level playing field with all of the other tech components that have already really reversed outside of ranges, namely Apple, which is just obviously screaming to the upside, Tesla, Tesla is out of its range, right? So if Meta is going to catch up, it's got to be over 183.78. Anything that consolidates in here is okay. And unfortunately, in this one, because it is lagging, I would be willing to look for shorts underneath the inverted hammer low to close the CPI gap up. It would also be moving underneath the top of the prior range here around 172.56. So watching this area for shorts really, and that can be triggered underneath the inverted bar low. Next up, we've got NVIDIA, what's going on in the chip space. Certainly closed that gap perfectly on the Thursday session. That was a great trade. We talked about it pre-market. Now we've got a double top there. If we can breach it, again, limited upside now, but still upside to be had into 192. From there, pullback or digestion here then makes a move like this much more reasonable to 200. The implications of a bullish bar closing above that Wix high, again, strikes me as sellers just not really materializing whatsoever, even on the gap fill reversal, right? Friday was a very impressive day back to the upside, so buyers in control. If it is going to be short at this point, I don't even know that I would want to be short NVIDIA or look for short setups unless we breached 169.50, which obviously is quite far away. I'm not necessarily seeing the reason in there for any short activity, right? Any sellers are trapped from that inverted bar. So to me, not seeing the case unless we take out the 50 SMA. So that's that. Next up, we've got Microsoft. What's going on in Softy? 3 days of balance here. Still watching for either the gap to fill overhead or the gap to fill underneath. Very simple. Over 291 or under 286.93. Call it 287, right? Round number. Next up, Amazon. What's going on here? Really more balanced as opposed to trending like anything else. So just like Microsoft, I suppose, it's either got to be over 144.85 in the 200 SMA for a breakout, moving to 150.25, or I would say at this point, still the short is only attractive underneath 137.58. There's a little bit of gap still in there from CPI, but overall patience is the move. 3-day balance, watching for an over or an under at this point in time. That's the core list. Let's get into these ideas. Quick reminder to hit the thumbs up button, the bell button, the subscribe button, all of those buttons YouTube tells us to tell you about, and let's get directly into the trade ideas. First on the chopping block is C for Citigroup. Really important to remember that financials are really outperforming to the upside here, so I'm looking for some follow through in this particular stock over the 3 equal highs, which are at 54.40. If we can take those out, I'm just leaving it scrunched out, or zoomed out rather, so you can see where the target is coming from here at 57.36, obvious area of resistance, and we've also got a 200 SMA waiting to meet us there as well. In terms of what's acceptable for keeping this trade on the table, picture perfect ideal consolidation happens above 53.77, the 2-bar lows. Acceptable consolidation that keeps the trade on the table is anything above 52.73. If we take it out, off the table. We did see a significant period of compression of range. Now we're looking for some expansion into that upper target. Next up, we've got Oxy for a petroleum company in the energy space, right? You've got a pressure cooker top forming on the daily time frame, inside bar on the upper half, 50%. Upper half, I should say, of the Thursday bar. If we can take this out, obviously that strikes me as bullish, and our target is the bottom end of this prior balance right in here at 68.55. If we never take it out, no trade, because there is a gap underneath that we could potentially fill if we see some downside. So watching for a possible breakout in Oxy. Next up is Oracle, which has already experienced a breakout, but seeing if we can get some follow through to the upside. Remember, markets move from compression to expansion. We've only seen one day of expansion, really. Let's see if we can get a little bit more follow through. This certainly was a nice healthy bull flag, and based on a measured move, right? If we just take out a measuring stick here and do this really crudely, we will duplicate that. And we'll do something like that. Obviously, you can see our first target this high in here is very reasonable for, measured move expectation of the bull flag. I'm not saying it has to get there in 1 or 2 days, but we are looking for continued bullish pressure inside of Oracle. I would not want to see it at this point in time underneath 78 again. Next up, last but not least, ABBV, ABBV, absolutely fantastic stock to have in a dividend portfolio, in the long-term portfolio. Full disclaimer, I own a lot of it in a long-term retirement account. So, I probably won't be day trading this, to be quite frank with you, but I do want to be transparent in terms of having a position or some interest in ABBV. I do like this pressure cooker top, quite frankly, on a smaller time frame, like an hourly. This looks like an inverted head and shoulders. There's your neckline at 142.80. It would also be a breach of the 200 SMA. Look left, thin structure from this earnings sort of conundrum here. Targets the 50 SMA, targets this prior low, targets this set of lows in here at 146.80. So liking this as a trade setup, I will be keeping an eye on it. And that is that. That has been the Weekly Watchlist video. If you enjoyed the video or learned anything new, let me know in the comment section or by giving the video a thumbs up. Don't forget that we will be live at 8:30 come Monday. And with that being said, I wish you all a green trading week.